content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. John Mintz does not provide tax or legal advice. All decisions regarding the tax or legal implications of your investments should be made in connection with your independent tax or legal advisor.
Have you ever wondered why the rich get richer and others don't? Could it be that a small percentage of the population pay others to find, study, and execute on legal loopholes that exist with our financial life and make it easier for them to prosper? The answer is a resounding yes. This is the Secrets of the Wealthy podcast with John Mintz. John has spent a lifetime researching and mastering the financial loopholes that he believes should be available to everyone. Join us as we explore different strategies that help you get farther faster towards building and enjoying a prosperous retirement.
Hello and welcome to the Secrets of the Wealthy with John Mintz. John, how are you today?
Hey, Eric. How are you, my friend? I'm doing great. And gosh, it's hard to believe this is our, 9th episode?
Something like that, yeah. This has been good. I mean, I love education. I'm all about learning something. I love to go on YouTube and watch videos and learn how to do things, how to fix things. Mm-hmm. I love this time that I get to spend with you because you're teaching me, and I'm kind of a blank slate in a lot of this stuff, and especially the topic that we're talking about today, because this is a continuation of a series that you've kind of started with, all about annuities and the truth and the lies about annuities, because there's a lot of not rumors, but myths out there. There's a lot of concerns out there. There's a lot of positive statements out there, and you're kind of helping us weed through it and know just kind of some of the facts and the truth about it. And right from the start, one of the things that you said is, look, everybody's situation is different. What is great for one person isn't going to be great for somebody else. And that's why it's so important to have this conversation with somebody who knows. And so that's why I'm here. I'm having this conversation with somebody who knows, and we'll give contact information out at the end of the show so anybody listening can have a conversation with somebody who knows. I appreciate your time. Can you tell the audience that is joining us on this podcast, maybe for the first time, what we spoke about on the last podcast, what you taught about with the annuities?
I sure can. Yeah, this is the third of podcast that relates to annuities, and I think this may be our last one. But we started in the first two. We talked about what is an annuity, just from the basic definition and what to look for. Then we went into three primary types of annuities, explained the differences between those three. Then we discussed the uses of annuities and how to properly use them or not properly use them. And then I think lastly, we talked about what to watch out for, the gotchas, as I call it. So today, I think it's going to be fun because we're going to get into talking about my favorite type of annuity today and break that down further and how it might be of value to some folks.
All right. And so what is your favorite type of annuity?
Well, not even close. My favorite type of annuity is a fixed indexed annuity. And when I was thinking about how I was going to explain this today, I thought about a trip I took a couple months ago, maybe 2-3 months ago. My wife and I went to Galveston for the weekend, extended weekend with a couple of friends of ours, another couple. And one night they pulled this game out. I don't know if you've ever heard of it. It's called Would You Rather?
Oh, yeah.
Okay. Well, I decided that night that I'm never going to play that game again.
It's a tough one.
But yeah, it is. So you get asked questions like, well, John, would you rather eat dirt or drink motor oil? And I mean, the answer is, well, neither. I'm kind of I think I have a little common sense, and I don't think I like either of those choices.
Diet plan, man.
Yeah.
Oh.
So anyway, but it's actually something I do with folks sometimes. They say, hey, do you think I should consider annuity? Do you think I should have an annuity? Of course, the answer is always the same. It depends, right? But I do ask them this question. I say, well, because they're thinking of getting their money out of the markets or a portion of their money out of the markets and protecting it, which a lot of people think are having those thoughts right now. And I said, let me ask you something. Which would make you feel worse? Would you rather, right? Mm-hmm. Which would make you feel worse? If you stayed in the markets, if you got out of the markets today, and in the next 12 months, the market went up 50%. Or would it make you feel worse if you stayed in the markets in the next 12 months, the market went down 50%? So if their answer is the second one, then a fixed index annuity might be a good option for them.
Okay.
Right? And so that's kind of a good starting point to see how people are, what their thoughts are and that sort of thing. And so the other story I like to tell, I may have told the story in a previous episode early on, but there's a guy by the name of Patrick Kelly, and he written some really good books. One of those is called Stress-Free Retirement. But he has his first chapter in his book, Stress-Free Retirement, is dedicated to he calls the poker chip mentality, which is exactly that, which is, hey, if we went into a casino, went into Vegas, and we walked up to a blackjack table, and if we bet $10 and we won, we get $10 back plus our original 10. But if we lose to the dealer, they take the $10 away. But he said, what if there was another table right next to that one? And if you bet $10 and you won, you only got $5. But if you lost, they wouldn't take anything. Which one would you play? And so table A is the markets, and table B is a fixed index annuity. So if you said, again, table B, then maybe you're a good candidate for a fixed indexed annuity, right? And so it's really what I call zero is a hero, meaning that with a fixed index annuity, it's fixed, meaning that we can't lose a dollar gained. It's indexed, meaning we're linked to an index, a market, but we're not invested in it. So when the market loses, we do not. And we get to participate in the upside of those markets, but we don't have the downside risk associated with those markets. So it's a personal favorite of mine for that reason, especially for individuals that are north of 50 years old and thinking, hey, I may not have the time to make up another loss if it takes me 5, 10, 12 years to, get back to even, right?
Mm-hmm, mm-hmm. Yeah, that makes a lot of sense. Along those lines, I'm just kind of curious. Obviously, how people would feel about something is one thing. I'm assuming that how people behave, and if they know themselves, especially if you're able to kind of get their behaviors out by asking certain questions, which I know you do. But if I'm a guy that maybe I come into a little bit of money, not an extreme amount, but maybe a small inheritance, $100,000, let's say, and let's say I'm 50, right? If I know myself well enough to where I would say, John, I'm just not sure. I've got this money, right? I might spend it. If I invest it, then it's not as touchable, maybe, but still I might have some access to it that I might want to spend it on a car or a boat, especially a boat, something that I don't necessarily need, but would be a want. Is it a good suggestion in your mind that I take that $100,000 and put it into an annuity right away that will pay me later or pay me right away? I don't know how we've talked about annuities work different ways, but what are your thoughts? If I know that I'm not as disciplined as maybe the next guy, is that a good idea for me to do something like that?
Well, I think that was Mike Tyson's financial manager's purpose for putting his money in an annuity at age 21. Yeah. Yep. So it is. I actually have these discussions with some clients because I get into, I really try to get to know the folks that I work with because I think I can be a better coach and advisor for them if I do. And if it comes out that I'm just not very good with money, that's kind of how they say it. But what they really say is if it comes into my household, it's going to get spent. And human behavior says, Parkinson's law says that expenses rise to meet income, period, right? To answer your question, I'll actually have some really direct conversations with folks sometimes and say, let's leave you a little bit of money, liquid-wise, so that if you feel like you need something, if you have a need, an emergency type fund, right? Let's have that available for you. But I tell them this. I said, let's get the rest of the money away from you. And they said, and you're not insulting them because they've already admitted this is a problem and they understand you're trying to help them. And yeah, even though they could still get at the money, they have penalty-free withdrawals, as what we call it, but theoretically they could cash in the whole thing even if it had a surrender penalty, but they just need it to be one step removed from them so that when that urge comes, they can fight off that urge. Yeah, that's actually a viable reason to do. Sure is. Mm-hmm.
Yeah. I mean, you're talking to a guy. I've done some really good things with money, and I've done some really stupid things with money. I mean, I was able to justify, my wife and I together justified leasing a minivan that was basically $240 a month more than what we had budgeted for, because it had 3 TVs inside, and it had these, John, it had swivel seats that had a small table in the middle so that you guys could eat in the back of the van together. And I thought, man, that's so awesome. We thought it was great. Oh, this will be great for trips. How often do you sit on the side of the road in your vehicle eating around a table? It's just the dumbest justifications we found, but we did it, and we were on a lease for 3 years, and something we could barely afford, and it hurt us long term. So I think that's good that you have these conversations, and I'm hoping that most of us can be honest with ourselves. If this money comes in, it's going back out. So yeah. That's
yeah,
great.
I do. You're bringing up some really good points, because I get off on these types of conversations sometimes, and they don't really I didn't think they'd ever come up in these podcasts, but here we go. I thought this would be really cool. I sometimes have people ask me, well, John, do you think that I'm thinking about buying a second home as a getaway type property. And I say, well, you need to really think that through. And they say, well, what do you mean? I have the money. I said, okay, or I could afford the mortgage or whatever it might be. And I said, well, how often do you think you'll go to this property on an annual basis? How many weekends do you go? Well, I didn't think about that. I said 2, 4, 8. And I have them try to come up with a number. They finally come up with a number, all right? And then we crunch the numbers on what this property will cost them. And it's not just the mortgage, of course, right?
Of course.
But it's not all the additional cost. It's time, too, a lot of it, right, to keep it maintained, especially if you're going to be leasing it out to others. And so we add that up. And then I said, now let's add up what it would cost you if you just lease somebody else's place for the same number of times. And in almost every case, it's significantly less money to have somebody else prep the place for you and you enjoy it, as opposed to the opposite. And yeah, that's a really good point that you make, Eric, and we get into these conversations. But yeah, it's not one of the uses I had written down here for an annuity, but it certainly is one, for sure.
Yeah, to avoid my own stupidity. I think I like that. I'll add that to the list. All right, so what else do we need to know about a fixed index annuity specifically?
Well, I want to just talk real quickly about the key components of a properly structured fixed index annuity. One of my favorite uses is just to use it for just pure accumulation, and I'll talk more about that in a minute. But I think there's a fixed index annuity can be structured properly, and it can be structured improperly, just like any other investment or life insurance product. The things that I always look for is I want an uncapped index strategy. If you're tied to an index, for example, the growth of your annuity is tied to an index, and if you have an annuity that's older than 3 or 4 years old, it's most likely has something called a cap on it, which means if your cap is 3% and your index grows 10 for the year, you're only going to get credited 3%. So I'm not a fan of that. I prefer the newer annuities and the newer indexes, which are uncapped, meaning I get to participate in the growth of the market without having caps or ceilings on how much I can grow. So that's number one. Number two is I look for high participation rates. So what is a participation rate, John? That's the percentage that I get to participate in the growth of the index. So if the index grows 20% and my participation rate is 20%, then I'm going to get credited 4. All right? So if my participation rate is 50%, I look for 50% or higher is kind of my threshold. So if the index grows 20% and I'm participating to the tune of 50%, I'm going to get credited 10. Now, as long as there's not a cap on there, I'm going to get 10. There are participation rates. The highest I've ever seen is 195%.
What?
Yes, believe it or not. In fact, that's on one that exists right now. It's one of my favorites. Yes, you can participate up to over and above what the index grows. And I don't have time on this session to explain how they accomplish that and pull that off, but it's pretty awesome to watch it happen. So uncapped index, high participation in that index, no unnecessary fees. And I say unnecessary, which means unless there is a direct benefit. So if you're going to be adding an income rider, for example, there might be a reason to pay that a fee for that because there's going to be an additional or direct benefit to that. But on just pure accumulation annuities, I in almost all cases do not suggest that. So no additional fees. And lastly, protected growth, protected meaning protected from the markets. So those are the 4 key reasons why I love a fixed index annuity. If we talk about what would we use, because you already mentioned one reason we would use it. If we talk about some of the ways we would use a fixed index annuity, especially for what we just talked about, I love it just for pure accumulation, especially today. I mean, rates are about as low as they're probably ever going to go. I know now they're talking about that in next year, it may be the first year the Fed decides to increase rates due to inflation starting to climb up on us now. Though definitely better than a CD or a savings account. I've had 3 different individuals this week. We had phone calls and they said, John, I have $800,000 in cash in a savings account. What do I do with it? Hey, John, I have $300,000 in this savings account. What do I do with it? I mean, these are not small amounts of money sitting in traditional savings accounts, right? Not even a CD or money market. And so it's just, they say in almost every case, they got out of the markets 6 months ago, 12 months ago, and you just don't feel comfortable getting back in. And so this is an opportunity for them to still participate in the markets and get a higher return on that money than they would sitting in a savings account, of course, without having to participate in the downside of the markets, right? So definitely someone who wants out of the markets, that is in the markets and wants out of the markets, even if it's a portion of their funds in the markets, or someone that's in a low earning asset like a CD or savings account that certainly is not going to keep up with inflation now that it's climbing. I think the number I heard the other day that this year they're forecasting is going to be 4.6% this year. Last year was 1.9. So I'd say we have a little bit of inflation coming. So that's the first strategy, would be an accumulation strategy. The second strategy would be an income strategy. A lot of folks approaching retirement are either going to be short income at retirement, or in most of the cases I see, they're just fine when they retire, but then inflation 10 years out is going to catch up with them, and then they're going to have a shortfall. Or when one of the spouses passes and they lose part of the pension or Social Security, then they're going to have an income shortfall. So it's a good way to fill that hole down the road that you know is going to be. So another great strategy. And then the last one, which I don't hear people talk about much, and I like, it's one of my favorites, is a legacy strategy. And I think we mentioned this on one of the other 2 episodes, but using an annuity to create a larger legacy for the family without having to go through the trouble or decline of applying for traditional life insurance policy is a really cool, neat little strategy of the wealthy, right? A secret of the wealthy that is allowed to pass more money on to folks than they would otherwise.
Wow. That's fantastic. Now, I want to ask a question just based on what you were saying. I know inflation can change things, and we know that taxes always are changing. There's always something afoot, if you will. Something's always going on. Timing-wise of getting an annuity, is there any urgency now compared to a year from now, besides, I mean, obviously potential growth and things that that you would miss out on by waiting, but is there some other reason that people should be looking at annuities now compared to a year from now compared to 5?
I'm going to answer that in a way that I don't think you're going to be expecting. The answer is no. And because these shows are not about me trying to convince anybody to do anything now as opposed to later, because in my mind, an annuity, at least a properly structured annuity, will be good. It was good yesterday, it's good today, and it's going to be good tomorrow. It's always going to be good. I think on the first episode I said annuities have been around for about 2,000 years. So they'll probably be around for 2,000 more. And so if it all comes down to what is your situation and what is your wants and needs, and is the annuity a good fit for you? And if it is, then let's get you signed up, right? And I'm a huge fan, as you can probably tell, I'm a huge fan of properly structured annuities in the right situation. Absolutely. For the right reason, too.
Got it. Yeah, absolutely. And another kind of an oddball question, but you have mentioned multiple times that there's this type of annuity, or just talking about the fixed index annuities, there's a variety of those, and new annuities come out, right? I don't know how often they come out, but just that, I guess that's my question. How often is a different type of or a new annuity created to where somebody should be giving you a call up, say, hey, is there something now that would fit my situation that maybe it didn't before? How often are things changing in this environment?
All the time. At least weekly. And I think the large part of that has to do with the growth of the retiring baby boomer population. And it was when we were in our 50s, the baby boomers were in the 50s, it was all about the Harleys, right? And so now it's all about protection of our assets. And the annuity companies, the carriers are changing products constantly to try to attract those baby boomers. And so an example would be, I have a company that has a product that typically has an 18% upfront bonus on it. So if you used the number 100,000 earlier, so we put $100,000 into this annuity in day one, our value would be $118,000. Well, from the beginning of May through this coming Monday, they decided we're going to increase that bonus to 25%.
Wow.
So I have some folks that are just kind of really excited about that. And so that's just through this coming Monday. So these kind of things happen all the time. So yes, I think more than anything that's driving the improvement of these products is the competition between the companies for the business. And of course, regulation drives changes too. But yeah, it's changing. It's so cool that you brought that up, because they really are changing all the time, which makes my job, you'd think it'd make it complicated, and it does, but it makes it really fun, because I can constantly take the best of the best and be giving it to folks. I don't just, like a lot of folks, I don't just work with one company, get used to that one company, and everybody gets that one company. I go to whoever has the best product for the client at that time.
All right. And last question, I think we touched on it before, but safety-wise, I know that we're running out of time here, and I don't want to get into a huge discussion with this, and maybe this is something we need to save for another time, but the safety of annuities. So how safe are they when you purchase one? What's the guarantee can they run out of money and not pay you?
Well, here's the way I like to say it, because my license prevents me from saying that there's no risk, or that they are uber safe, all right? But I always like to focus on facts. And so I go back to the Great Depression, which I think most folks would say is the financially speaking, the worst times that we have ever been through. And in the Great Depression, if you tried to Google the list of banks that went out of business during the Great Depression, you better have a lot of paper to print it on, okay? But if you Google the list of A-rated life insurance companies that went out of business during that same time, it'd be blank.
Wow.
Okay. And A-rated life insurance companies are all I deal with. I mean, there's other types of life insurance companies, but I don't deal with anybody but that for that reason. And most of those also pay dividends to their traditional life insurance products, whole life, for example. Those same companies pay dividends during that same time. I think the statistics say that a bank can lend out $10 for every one that it takes. I don't know why that is. It should be criminal, but it's not. It's legal. But an insurance company, an A-rated insurance company, is a 1-to-1 ratio. So when times get really difficult, really tough, I guess the question for you is, would you rather have your money in a bank or in an annuity with a life insurance company?
Yeah, that makes a lot of sense. And that 1-to-1 ratio you're talking about, they can't overpromise like a bank can. In other words, they can't overextend themselves.
Exactly. So when there's a run on a bank, right, it really is a run.
Yeah, no kidding. Absolutely. All right, John, great information today. I said at the beginning, we're going to give out the contact information so people can call and ask their own questions, their own scenario. You can sit down and get a chance to meet them and know them to know what's best for them. How do they get a hold of you?
Yeah, and before I do that, Eric, I kind of feel bad that I haven't done this sooner, but I just want to take just a second to say thank you for hosting this show. I know you put a lot of effort into it and a lot of time, and I just really appreciate you joining forces with me to try to make a difference, a positive difference out there, folks that just need help. So thank you so much for doing that.
Wow, that's very humbling. And I got to say that I feel like I'm getting the better end of this deal. I'm getting an education for free. So thank you for that. And no, that's powerful. Thank you so much. I appreciate that. I enjoy this every time we get together.
Yeah, same here. But if anybody wants to reach out to us, they can reach us at our main office number, which is area code 817-225-6260. And our website is Biltmore-financial.com. Again, that's BILTMORE-financial.com.
Wow, fantastic. John, again, thank you so much for your time today. And of course, thank you to the listening audience for tuning in and listening to the Secrets of the Wealthy podcast with John Mintz. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at the Secrets of the Wealthy, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Secrets of the Wealthy podcast with John Mintz. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of John Mintz. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.